Broadcasting from the commodity capital of the world, Zurich, Switzerland, this is Insider's Guide to Energy.
This edition to Insider's Guide to Energy is brought to you by Expectancy. Go to www.expectancy.com for more information.
Welcome to Insider's Guide to Energy. I'm your host, Chris Sass, and with me this week is Jeff McNally. Jeff, welcome to the program.
It's great to be here, Chris. You know, we had so much fun on episode 76. Couldn't wait to get on the other side of the microphone and talk about some really exciting esoteric topics with you.
I am so excited to have you co-hosting these episodes with me. This is your first episode co-hosting, so no pressure, but the audience is going to wonder how this goes. So why don't we kick off? Why don't you tell us what we're going to talk about?
Yeah, well, when you asked me to co-host a few episodes this year, one of the first topics that came to mind is grid scale energy storage. And most of the listeners will have heard of energy storage as being a key link to enabling wind and solar on the grid, but the jargon is insane. There's so many different terms, different markets, different units, it's hard to keep track of. So I'm really excited that we have Adam Heiss here from Ascend Analytics to help us make sense of it all. We're headed to potentially 100 gigawatts of storage by the end of the decade with only 16 gigawatts today. How are we going to get the rest of the way there? Adam is going to help us demystify the markets, the financing mechanisms, and close to my heart, of course, the risk management to enable the financing. Adam, welcome to the show.
Thanks, Jeff. Thank you, Chris. Very glad to be here.
As you could hear, we have big expectations of what you're planning on doing. Those numbers are pretty big. You know, how are we doing towards that 100 gig destination of storage? Where are we at?
So I think Chris mentioned this year, Ascend expects to hit about 30 gigawatts across the country deployed. It's a mix of large-scale projects within wholesale power markets, as well as projects that are being directly contracted with utilities. I think the bigger question is, not how have we gotten here, but how do we get to the next step? And when it comes to, how much storage is expected, ultimately the conversation is generally around how much storage is needed. And that's an interesting way to put it, right? Because it's not how attractive is it going to be to build 100 gigawatts of storage. That's 100 gigawatts of storage is needed to manage reliably a grid that is powered largely by clean, renewable energy. And so the question then is, if that much storage is needed, how do we incentivize that deployment? If it's not the government funding all these projects and we actually expect private investors to put up the capital behind these, what is their incentive? And to date, that has been one of the largest challenges facing storage. And so my focus over the last couple of years has been how to navigate that challenge of actually incentivizing private capital to deploy the hundreds of billions of dollars in energy storage assets that are needed to get to that 100 gigawatt number. I think the biggest risk that we face today, it's not deploying storage fast enough in order to ultimately face reliability challenges and give credence, give an audience to the voices that are calling for regressive fossil fuel supporting quote unquote resiliency policies. Deployment is what's necessary.
So Adam, I want to orient a little bit on the market and then get into your personal background of how you came to this challenge. So first of all, when we're talking about grid scale energy storage, so we're not talking about the power wall on the the residential garage. We're not talking about maybe a stem battery doing peak shaving at a commercial building. These are giant, multi-megawatt, sometimes hundreds of megawatts tied to wholesale power plants, wholesale markets, largely in California, in Texas, in PJM. So help us orient to what the biggest markets are there today and what they're selling into. I think people generally have an idea of the buy low, sell high energy arbitrage, but of course we know that batteries are often revenue stacking. So orient us on this, and then if you would tell us a little bit how you came to the challenge.
Sure. So I guess I want to frame this in, not dismissing the residential, the commercial, the community scale projects, but rather just focusing on what Ascend's target market is. And that is, to your point, utility scale projects that are participating in wholesale power markets. Our focus is in that arena because the uncertainty as to how effectively projects will return the investment is challenging the upfront investment. The opportunity today for utility scale energy storage is largest in the Texas power market. That said, the storage market is largest in the California ISO, and we can talk about why there's a difference there. Ultimately, the value that storage assets are providing to these grids and how they are being compensated for providing various services is a function of the need for resiliency, the need for reliability, and the price volatility that results from markets that desire resiliency services. I think a lot of the conversation around energy storage is typically with respect to the buy low, sell high conversation. That is not incorrect, but it does somewhat miss the mark in terms of how projects are making money today. So in the Texas power market, which is broadly, I think, acknowledged or understood, at least by those who are in the industry, as the most interesting place to be doing batteries, we are operating, I think, 3 gigawatts of wind, solar, and storage assets with our optimization platform. And for storage assets, very rarely are we optimally using the battery by pursuing a buy low, sell high strategy. It's largely today being utilized to provide frequency management to the grid and to provide backup capacity. So there's a what is the state of play for storage today question, and where does that go? But I guess to summarize, where things are today in California and in Texas, where batteries have seen the largest deployment, the opportunity to make money is not in a clever arbitrage strategy as much as it is in providing reliability services. That changes quickly, and we anticipate that change. We're expecting the cannibalization of those revenue streams as more storage comes in, which affects the investment horizon. It affects the risk transfer market. It does infect it in a way. And yeah, as we think about the evolution of all competitive power markets in the country, this is a critical consideration for us. Excuse me. I thought that was me. So as we look at markets that have been historically the fastest movers in renewable energy deployment, there's a very strong correlation with the opportunity for energy storage. We see a empirical relationship between the net renewable energy penetration in a market and the need for energy storage, the value that is provided to storage by the market for the services that it provides across the reliability services and energy price arbitrage. And so, naturally, California with all the solar that's in that system, Texas with all the wind, and now increasingly with a lot of solar coming in, those are the biggest opportunities for storage. As markets like PJM and MISO and New York experience higher levels of renewable penetration, that's a combination both of new wind and solar coming in and thermal going out. The opportunity for storage to play a meaningful role in both keeping the system reliable and supporting
Yeah.
more wind and solar and less thermal becomes really critical.
That's great. And so we've talked a little bit about the markets. You mentioned that you've got several gigawatts of assets that are using your optimization. Well, maybe this is a good time to talk about your day job and what you do at Ascend Analytics, and how you came to such an interesting position in the market.
Sure. I've been with Ascend now for 2 years, working on designing new structures for managing energy storage revenue risk. That's the result of now 3+ years of working on solving that problem. I spent a year or so independently developing a solution to this before Ascend acquired that. Ascend is ultimately the ideal parent, the ideal provider of this solution, because in order to manage storage revenue risk, you have to first and foremost, I should say, in order to transfer energy storage revenue risk, you first have to understand it, and then you have to effectively manage it. So Ascend's valuation tools are used across the industry by developers of clean energy assets. Ascend's portfolio management tools use a stochastic framework to evaluate hundreds of simulated weather conditions, driving hundreds of potential price scenarios. Ultimately, that looks a lot like a actuarial pricing model that insurers and the like are familiar with. And then our operational platform is an algorithmic dispatch engine that is a very effective framework for managing the risk of how an asset participates in a minute to minute, hour to hour time step.
How
So please.
how is revenue risk weighing in? So you talked about peak shaving. We talked about early use of battery storage, right? That was
Mhm.
kind of your prelude to this conversation. As you talk about your day job, you're saying, hey, we help with the risk assessment here. How is that weighing in, and how important is that to hitting the goals so that storage and that reliability is going to be there? How are these tied together?
First and foremost, I think understanding how an energy storage asset can valuably participate in the market today is essential. Right? If we have an understanding, an incorrect understanding that a battery project is just going to be buying low and selling high, we miss a huge component of near-term value that a battery can capture by being an early mover into a power system like the Texas ISO. But that has to be combined with an understanding of how that market evolves as more storage comes in to capture those low opportunity cost ancillary service opportunities. We expect the same sort of dynamic that has played out in renewables, with a flood of contemporaneously generated low cost renewable energy. You saturate energy prices when generation is highest. In like manner, a lot of energy storage coming in and trying to sell the same services crashes the price of those markets, and new forms of revenue opportunity must arise to support those assets. It's not deterministic so much as understanding, if batteries are coming in and providing all the reliability services that a market needs, there's still going to be intermittency, and more so as that reliability service that batteries are providing allows thermal assets to be retired. Right? So it's a somewhat self-fulfilling cycle where more storage coming in saturates the reliability services that thermal is providing. It pushes thermal not just out of the supply stack, but ultimately out of commission, putting more pressure effectively on clean energy assets to provide supply when demand arises, and ultimately places more opportunity for energy storage to do that buy low, sell high strategy that
Yeah.
does become the predominant form of revenue over the longer term.
So Adam, I think this is really exciting. You touched on a few key points. So one is we see across renewable markets, as you have more wind producing more electricity, when wind is producing more electricity, that can collapse the power price exactly when it's produced. And so this is sort of a self-cannibalization that can happen in large-scale renewable markets. You mentioned the same thing can happen with batteries contributing to ancillary services markets like frequency regulation. But what you just touched on there is that it's not that renewables and batteries are cannibalizing themselves, but together can push out traditional fossil generation. I like to call this peaker parity, not grid parity, but peaker parity, when renewables plus batteries, or potentially even batteries by themselves, are displacing gas peaker plants or potentially other less efficient ones. What do you think about this concept of peaker parity? And when you think about it in terms of grid parity, how close are we to that point with energy storage today?
The economics for private investment in energy storage are stronger than they've ever been. And I should caveat that it's not wholly public investment at this point with all the new tax credits that are available to energy storage participating in utility scale markets at this stage. But across the country, in the wake of the passage of the Inflation Reduction Act, we're seeing projects move forward. And pre-IRA, most projects were getting built in Texas, supported by lucrative market value. In California, supported by a combination of bilateral capacity contracts and lucrative market value. And that was about it. I mean, utility offtake opportunities here and there as Dominion or Duke or a utility, Con Ed in the Northeast that has an interest in supporting technology that isn't necessarily viable in the wholesale market on its own, entering into a bilateral contract. So with the tax credits that are now available, we're seeing projects move forward in MISO, in SBP, in PJM, in ISO New England, as well as in New York and California and Texas. The opportunity to make an incredibly compelling return from a storage investment is driving private capital into that market. The question that becomes really interesting, and I won't pretend to be an expert with respect to determining where across the country we are achieving that point of peaker parity. I think there's been some really interesting studies that have come out just lately looking at how I think 99% of coal plants could be reliably replaced by local renewables and storage, right? People are doing some fascinating work in that sort of localized assessment. What I think is really fascinating is how the incentive changes for the next wind farm to be deployed to further, wind supply in a market that's already, based on price signals, relatively saturated. And likewise with storage, as we look at storage cannibalizing market value for itself, it's also dramatically reducing the incentive to build the next energy storage project, despite, us still being far from that target of what we need, right? And so there's this question of not so much, are the economics in theory compelling, but how do we make the investment overall attractive, right? And that's a question not just on revenue, but on returns. How do we de-risk this investment to a degree that makes it possible for, with falling revenue levels for wind and solar, that's still to be an attractive investment for really low cost capital. Mm-hmm. With storage right now, we're, I'd say, a few stages away from hitting that point of saturation, certainly, but also of low risk investment appetite for energy storage investment, right? Mm-hmm. The challenge that we face is what wind and solar faced, say, wind maybe 5 or 7 years ago, solar 3 to 5 years ago, of how do we de-risk these projects to a degree that makes them attractive to the huge pools of low cost capital that we need to attract into this sector to achieve that needed 100 gigawatts in the next 7 years.
And it's a great example. So with renewables, one of the primary mechanisms of managing market risk was just to have a fixed price PPA. And you can have that offtake, and it's a utility scale, highly rated entity. But what you highlighted there is in some markets, you can have bilateral capacity contracts. But in some markets, like Texas, there isn't a capacity market, or it doesn't really make sense to have a bilateral contract for ancillary services or for energy arbitrage. So you're left with, help me understand, a majority of the revenue potentially is merchant. And so that bilateral contract isn't really viable to do the risk management like we saw in utility scale renewables. We need other forms of risk management. So tell us a little bit more about what that is in the case of these merchant batteries.
Yeah, I would caveat, I would agree generally with your assessment. I would caveat the point that the bilateral contract doesn't exist because it hasn't been created yet. I think there is bilateral value based on the way that energy storage participates in the market and how the conditions that drive value for storage drive negative exposure for other market participants. Generally, though, I mean, stepping back a little bit to the quote unquote revenue stack, if energy storage is participating across ancillary services and energy price arbitrage, buying low, selling high, and say in a market like California where there is a capacity construct selling capacity forward as well, the question is how do we manage the merchant risk? Are there elements of, say, ancillary service market value that we can hedge? And sometimes there are, and projects can sell forward, their exposure to low ancillary service prices in exchange for giving up the value that they would otherwise receive during periods of high ancillary services. And likewise with energy price volatility, if I as a battery owner benefit from high levels of price volatility, then I can sell that forward to someone who is harmed by that price volatility.
What do you call, Adam, sorry, what do you call that? Is that a vol put? Like, what is that? Or please, the energy trade experts jump in here.
Folks like to call it a TB trade, a top bottom trade. So you
or a cap and collar. Is that another term, or is that different?
I haven't heard that with respect to the energy price spread, but the general concept there is, if I have a 2-hour battery, I can sell forward a spread that's based on the top 2 and bottom 2 energy price hours of the day. Say it's a $20 spread. That means if the top 2 less the bottom 2 hours average out to greater than $20, I am paying away some of that upside that in practice dispatching to prices that are more volatile than that $20 spread would indicate. I'm paying away some of the upside that I realize, but if prices are less volatile and that spread is less than 20, I get paid out to protect myself. So
is the infrastructure to do this in place, or is this like what? How are people doing this today, right? So because the things you're talking about right now are very short term, right? And so if you're looking at a project and you're talking about de-risking the project, you're de-risking short term and long term. There's different risk at different points. So what does the infrastructure look like today to handle these kind of risks?
Limited. It's early innings with respect to the evolution of the risk transfer ecosystem, I would argue. And I think looking at the evolution of similar ecosystems for wind and solar, it's easy to draw some parallels and to make some, I think, well-educated guesses as to where this needs to head. Wind and solar have a rich landscape of risk management tools available to them. Jeff alluded to the physical PPA with the utility. That evolved into virtual PPAs with corporate buyers. That evolved into fixed for floating swaps with commodity desks and insurance-backed revenue swaps. To date, the options available to energy storage look a lot like a physical PPA with a utility. You get a fixed price and you give away all of your market risk. nice for pension funds who want to clip coupons, but not particularly attractive to infrastructure equity funds who need a level of certainty but want to retain exposure to what are expected to be super normal returns to energy storage assets as they adapt to high levels of renewable penetration. The short-term hedges that do exist are highly illiquid. There are buyers who want to benefit when a storage asset does, to high price volatility, to high ancillary service prices that as a load serving entity you have to buy from the market. But the depth of that market is, well, not very deep. And the challenge of entering into a long-term offtake structure to manage your market risk, as we and I think everyone expect those ancillary service markets to be saturated. Even if you could lock in a 5 or 7 year deal, it's going to be of limited value as those markets fall toward very low prices.
So is the growth problem or the demand, the growth, a capital problem that we're talking about, the risk problem, or is it a technology and demand problem? Like what's going to be the risk in the gate of this actually getting deployed and having the kind of infrastructure that folks want in place at the right time?
It's a great question. And 6 or maybe 8 months ago, I would have said the challenge is almost entirely a sourcing of capital challenge. Today, that's a little bit different because actually getting projects built is running into all forms of supply chain challenges. So in that sense, somewhat technological constraint on deploying the technology that's needed. Ultimately, I don't anticipate that being a long-term constraint with the sort of manufacturing capacity that's being scaled up in the wake of tax incentives in part. The bigger long-term challenge, I believe, is how we finance this transition, how we finance the scale of storage deployment needed to support for further wind and solar projects, how we finance the wind and solar projects as we see their market value eroded by scaled up deployment of similarly participating in the market projects. It's this concept of kind of a devaluation of the normal assets, right? If all of the wind in California is blowing at the same time, and we know all the sun, all the solar generation is generating at the same time, ultimately building the next solar project, building the next wind project is going to be of low enough value that no private investor is going to take that on. And similarly with short duration batteries, as more 1 and 2 hour batteries hit the system, the value of the next one falls. And it pushes us, I think, to move beyond further deployment of the normal and to start thinking about what's on the fringe, whether that's geographically diversifying or technologically into the vast variety of assets that can benefit from super abundant clean energy in certain periods of the day. It, I think, ultimately changes what we mean when we talk about storage. Storage, buying low and selling slightly less low, is less compelling at a certain level than it is to buy low and create something else.
So I want to come back to that, both the long duration and the other forms of providing the same service. But if we can just go back to the contract structure for a second, because I think this is really interesting. And people listening may have just gotten their heads around the virtual PPA, which is a contract for differences. So it's non-physical, financially settled. A buyer at a wholesale wind farm or a solar farm has a strike price, and they owe the difference between the strike and spot. What you were talking about with batteries is a contract for differences, which is there's a spread between the high and the low on a daily basis. The battery's capturing that spread between, like you said, too high or too low, or, N high and low. And then if that realized spread is different from the contracted spread, so it's a spread. What do you call that contract, and who is actually entering into that contract today?
So generally, you're right. There is a spread effect going on there, but generally people would just refer to it as a top bottom spread, and it has the same settlement mechanism as you described, a contract for that difference. The predominant market participants there have been utilities and retailers who are looking to benefit from volatility that otherwise harms them. We have seen, I think, one or two corporate buyers enter into one of these transactions. I think the correlation between economic benefit that they receive from that contract and their actual exposure to market prices is a little bit less obvious relative to the virtual PPAs that many folks have entered into. If prices in the Texas market rise to $100 a megawatt hour, Walmart is going to be exposed to buying at higher prices. If the difference between prices goes from negative 30 to 50, and Walmart benefits from that volatility under this trade, it's not necessarily going to as directly impact them. And that's, I think, one of the challenges in thinking about who is really best suited to be on the other side of one of these hedges from an energy storage project. It's as yet a little bit unclear as to how valuable that is to a corporate buyer. I think to retailers and folks who are exposed to demand more broadly, there is an interesting opportunity there. But I should say too that I don't want to come off as either promoting or really dismissing these forms of trade. I think they have been useful, certainly in getting some projects built. Many of the projects that are operating in the Texas market have been financed on the back of a relatively short-term forward sale of ancillary services. So locking in that ancillary service floor and giving away your upside. The challenge is that we've seen projects take on, at times, catastrophic risk under these trades, right? They have, in concept, protected themselves from low prices, and they've exposed themselves to very high prices. And if those very high prices occur when the battery is not actually able to participate in the market, they're still exposed to that trade. And that settlement risk was illustrated quite emphatically in Winter Storm Uri, when many projects faced hundreds of millions of dollars in settlement. And that was not just for energy storage, but across wind and solar as well. And so our motivation in developing new forms of risk transfer, particularly for storage at this point, but also for wind and solar and other forms of power market participants, is to manage revenue risk without creating new forms of settlement risk and avoiding the introduction of new forms of exposure while trying to manage the actual market risk that a project faces.
Did the longevity or return on investment in these products change from, so if you're from the energy industry, right? So if I put a nuclear plant in, or if I put in a coal plant or any kind of turbine plant, I expected a really long maybe window of opportunity to get my return. And so with renewables, and you're talking about price compression as the market maybe gets abundant abundant resources, too many people, too many wind plants, too many solar PV parks go put in. What is the life expectancy of a battery project, and how is that performant compared to maybe how we've been looking at energy in the past?
It's an interesting point because I think it speaks to the investors that are participating in the market at a given point in time, and a potential recalibration of expectations as the market evolves. Fundamentally, I think the technology, the markets, and the form of risk transfer evolve together. There's this coevolution, looking back at, say, wind and solar, wind generation fell in price. The price at which the price at which a wind generator had to sell its electricity to earn the target return fell as the cost of deploying the project did, which allowed new forms of risk transfer to emerge in the market from traders who saw that output as increasingly competitive, which allowed new investors to put up the capital in those projects because they now had this long-term form of risk transfer, right? So with energy storage, people are talking about 20-year, maybe 25-year project lives, but no one's seen a storage project participate in the market for more than, in the PJM market now, maybe a decade plus. But the return expectations are, I think, necessarily calibrated to what has been possible. And in the Texas market, where you could earn a full return on your installed cost within a matter of years, that super normality of returns is going to dissipate. I mean, the market will drive toward a level of equilibrium where installing the next storage asset no longer earns a supernormal return, right? And in order to continue to attract investment when we've evolved past this supernormal period, it requires that we find the right tools to manage risk to attract the sort of investors who are interested in that sort of return profile.
So where does this go? Adam, you also mentioned longer duration. And so first of all, just to orient, the units of batteries are always in megawatts and megawatt hours. So 2-hour battery, 100 megawatts, 200 megawatt hours. It sounds like, you mentioned a 2-hour duration, but maybe it's more common to see 4-hour. Are we going to see that increasing? Is that the trend in order to capture some of the value that you're alluding to?
Ultimately, yes. Today, we don't see significant marginal value of additional duration with respect to how the projects are participating in the merchant market. In a market like California, where you can sell the capacity and you get additional value for additional capacity, it is driving longer duration. But for the most part, the long duration projects that are being deployed are on the basis of a bilateral contract that basically specifies thou shalt not sell us less than 6 hours of energy storage duration. The opportunity over the longer term, though, is with that devaluation effect, right? As 1 and 2 hour batteries continue to march toward less and less value, the opportunity broadens, right? The price spikes stop occurring in that 1 hour because all the 1 hour batteries are targeting it, and they start spreading out over 2 or 4 or 6. I grew up in a coal country, so my mind goes to a mountaintop removal analogy where when you start capping off the top of that peak, it's pretty thin, and over time it gets broader and broader. And likewise for the opportunity for energy storage, ultimately it's going to be in providing energy arbitrage over longer and longer durations. That said, in most markets, we anticipate that doesn't become viable just on a merchant basis until late this decade.
Hmm. And so when you talk about clipping those early peaks, is that, we're naturally slipping into the energy arbitrage language that we acknowledged earlier on is not the highest value, but today it's ancillary services. And if I understand correctly, ancillary services are much more of a high power, high frequency, lower energy application. And so in your analogy, those are the markets that are going to get clipped first by the shorter duration batteries. Is that right?
Correct. And ultimately it's a function of the opportunity cost. If I have a 1 hour battery in the Texas market, there's a very low probability that I'm actually ever called on to provide my capacity. And if I am, it's usually for 5 or 15 minutes at a spell. And so a 1 hour battery can participate in this lucratively priced market and not see much additional value for 2 or 4 hours. the opportunity over the longer term is, as that market becomes less and less valuable, the project then falls back on making a decision in each hour. Should I provide this less valuable service or try to buy low and sell high? And ultimately it falls to that opportunity cost of buying low and selling high in our analysis.
So we're peering a little bit into the future, and your business, in fact, is looking at long-term trends. So we talked about the trend towards longer duration, but what about alternative forms? In 10 years, maybe we've got EVs, and we don't need grid scale battery storage because the EVs are providing the dynamic charging or ancillary services or things like this. When you look out over that decade time frame, do you see other maybe less traditional forms participating in the same markets?
Yes. But but I would argue that it's not so much entirely less traditional forms participating in the same markets, but also the evolution of new markets. As extremely cheap and sometimes negatively priced electricity becomes more and more available, the question is how do we adapt as a not just economy but a society to utilize that in ways that are beneficial economically, are beneficial environmentally, are beneficial socially. And I think the opportunity to leverage super abundant clean energy to support industry-wide decarbonization, to support the production of clean air, clean water, clean locally manufactured food even, become really fascinating opportunities. It requires a broader lens than I think we've taken on the evolution of the power sector. But that's where I see us going, and the opportunity to provide the risk transfer that's necessary to deploy technologies as they become increasingly exposed to power market price volatility. I think our lens has to broaden with the aperture of the evolution of this entire sector, powering the evolution of our broader society.
I think we've taken a pretty broad journey here. We've gone a long way from the start of this conversation to the end. I think my takeaway is that it's an evolving target, that things are moving. We're still making the rules as we go a bit. And you've highlighted a few opportunities for finance and risk transfer to make sure these deals take place, that we get there and scale. That's what I've heard in this conversation. I want to thank you so much for sharing with the audience and with myself. For me, it's been enlightening to kind of get a different perspective on where things are going. So thank you so much for coming on the podcast today.
Absolutely. Thank you for having me.
And Jeff, your first episode as a co-host, I really appreciated having you here. I'm looking forward to more episodes that we're going to do together. This has been fun. For our audience, I hope you've enjoyed this episode as much as we have. If you have, don't forget to subscribe, follow, share it. You can find us on Facebook, YouTube, anywhere you get your podcasts. And we look forward to speaking to you again next week. Bye-bye.